Manish Sonthalia joins us. Let's take our conversation forward and understand what he makes of the market setup. Good morning. How are things?
All good, Nikunj. Good morning. I think as far as the markets are concerned...
But I didn't have a market question for you. I was asking you, how are you? Are you watching cricket? How's life? Enjoying weather? We start with markets.
Lots of red in the background.
Yeah. There is life beyond markets also, Manish bhai.
Correct.
चलो मार्केट पे ही बात करते हैं. चलो अब आप मार्केट ही बात करना चाहते हैं. Let's talk markets only. Yes, sir. Markets.
So, we have seen some decent move on the upside. FIs have started buying. Those are the positive things about the market. I think there are some negatives as far as global macros are concerned. The debt ceiling and obviously bank failures in the US is an overhang out here. El Nino monsoons are an overhang, but otherwise, nothing worrisome on the micro front. I think earnings in the latter half of this earnings season has been pretty good as opposed to what the expectations were, particularly regarding the consumption stock. So since we have had a decent run, we could see some sort of consolidation between now and September. And obviously third quarter onwards, we see the markets again moving higher and the build up into calendar 24, where I think that a solid 15 to 20% absolute returns on index is very much possible.
So what's been your portfolio strategy? Are you still sticking to financials? Are you still buying into autos?
I think the pillars of earnings growth for at least fiscal 23 as we see it is basically financials, technology, automobiles, coming out of a hiatus, contributing very well to the earnings growth, and consumption more on the discretionary side as opposed to staples leading the earnings growth in the second half of this year. So, and obviously industrials due to build up on order book as well as your execution. So I think these are the four pillars where I think you could get outperformance. And obviously if you don't own commodities, oil and gas and utilities, etc., it should be working well for the portfolio. That is how the portfolio is positioned currently, leaning on four sectors and particularly your BFSI, technology, automobiles and industrials, and as a counterplay on pharma, where I think the worst is already behind us.
You had a big position in Manyavar. Are you still sticking to it?
Oh yes, I mean, if you see the numbers that have come out for even this quarter, it has been a rock solid 20-25%. And this company particularly has characteristics of a Page Industries 10-15 years back. You're coming out of you are basically an organized segment in a category which is by and large totally unorganized. You are present in the men's segment. You have segmented the entire piece for yourself. In the middle, you have Manyavar. On the premium side, you have Maeve. And on the value side, you have Manthan. Then you are left with the women's category, which is again a very large market, 130,000 crores, or out of the 150,000 crores, where you have straddled with Mohe. And obviously, it's all about penetrating the length and breadth of the country. They are now at 600 stores plus. Your total area under operation is going to move up by roughly 15% on a base of 1.5 million square feet that they already operate in. So, and the business model is fabulous that you outsource all your manufacturing and you pay handsomely to your franchisees to sell your product. Results in asset-light model, very high ROCs in excess of 50-60%, net profit margins in anywhere between 25 and 30%, and a payout ratio of anywhere between 30 and 40%. I don't see why, if you can double your profits every 3 to 4 years, the multiple which is being already alluded to be, on the higher side would come down, and it's a growing category within the organized space. So continue to own Manyavar since the day of listing and getting more conviction on this name as the quarter progresses.
Manish, I'm curious to know whether within the urban consumption trend, have you added anything beyond Manyavar?
Actually, as far the Zomato is one of the names which is basically catering to urban consumption. So against the crowd, basically I continue to remain extremely positive on Zomato, and in fact the food delivery platform. And I'm one of those guys who really don't believe that ONDC is going to disrupt food delivery per se, because ONDC, to my mind, will disrupt one to many platforms. It could disrupt a Blinkit, which is basically one servicing many customers. But in the case of food delivery, Zomato, where you are servicing many to many, which is many restaurants using your platform to cater to many customers. Out here, I think ONDC will have a challenge, and there is space for both Swiggy and Zomato out here. And I think, again, they have solved the profitability puzzle ever since the day of listing. No longer is it about negative EBITDA margins. EBITDA margins are going to be positive 5%. And even on a net PAT level, I would presume that, they would actually make net profits in the year fiscal 25-26. And EBITDA closer to 3,000 crores in that time frame. So, excluding the cash value of the platform at 40,000 crores, that is what we got to understand. I think there is definite value, and the stock is a multi-bagger 3-4 years down the line.
Having said that, Manish, I don't know if you're concerned at all about the spate of PE investors now cutting their valuations for some of these tech startups, right? I mean, Ola, for instance, 35% cut coming in there by Vanguard. Swiggy Invesco has sliced it down twice this year to 49%. Similar is the case with Oyo, Byju's, Pine Labs, PharmEasy, all of them. You think funds as such are drying up within this space, and is that likely to keep the valuations within the listed universe as well under check?
So in a rising interest rate scenario, all these things are bound to happen. We are coming out of a regime where there was zero cost of capital 2 years ago. And today, cost of capital is significantly higher than those levels. So, if your denominator is expanded, your valuations is obviously cut. There's not too much of change as far as the slowdown or the earnings aspect of the valuation part in these companies are concerned. Liquidity has definitely become more tight, so it's not a case of a blanket availability of capital for all startups. It's got to be picky and choosy, but there's definitely capital available. There's no dearth of capital if the business model is right and you have an early mover advantage. So yes, there was an overdoing on the valuation side maybe 2 years ago when the run-up to many of the IPO listings. Those listings were not particularly, palatable as far as the valuations were concerned. Right now, I think some of these businesses will become very big from the levels that they are. Not all will succeed, but some will succeed. And obviously, a de-rating on valuations, markdown on your investment value, re-rating of valuation is all a part of the investing journey. There's no saying that if the valuations today are, let's say, de-rated, it can't be re-rated. And in investing, really doesn't really matter who is buying or who is selling. If there are large PE holders who want to exit, market is a platform where you will get an exit at the price that you want, but there'll always be a buyer for a seller. And in that context, I believe that it's a part of an ongoing journey of investing.
Manish, let's also get in your view then on the entire pharma theme. You believe that it's in for a strong comeback?
100%. And again, out here, there's a conundrum, and I don't really understand why the markets are not so mature to look through this. See, during the pandemic, a lot of excess capacity came in the global system of manufacturing of pharmaceuticals. So nobody had a handle of how long this COVID is going to last. So a lot of players both got into both oral solids as well as injectables, both on the complex injectable side as well as the generic injectable side. Then came the pandemic, and then the pandemic went away. A lot of the stocking that happened during the pandemic, that is calendar 21 and 22, right now we saw some superlative growth in pharma names during these years. Right now is a phase of basically destocking that is up. And once this destocking gets over and a phase of again destocking starts to begin, a normalization of inventory, you'll see less of this price competition and undercutting, and new molecules getting launched, etc. So I think today the de-rating process is on, and if you were to look, let's say 1-2 years down the line, and we are talking in an environment when the valuations are literally half from what the valuations of pharma companies were, let's say 2 years ago. and normalized growth of, let's say, within domestic companies, 15 to 20%, and even in the global context, around 12 to 15%. A lot of players are actually going to move out of business due to price erosion, and the profit pool is going to get shared with a lesser number of players. In that context, given the longevity of growth in pharma companies, I would believe that this is an apt time to buy some of the names that we like, and could create some significant returns, in some of these names from where we are.
All right, let you go on that note. Appreciate your time. Those are some of the interesting themes and stocks that you're watching out for.